Hey everyone, welcome back to another episode of Stage Debate with Cost Seg Isaac. Today is episode number 7. We have some phenomenal guests. We invited on a few CPAs, folks in the industry who are smart, and savvy people. Nicole DeRosa, Brandon Hall, and Chelsea O-Shields. These folks have done a tremendous amount of work in the tax space. They know the tax code inside out. They've worked with a lot of high net worth individuals, investment firms, really teaching them and strategizing with them how to get things done in the right way. I'd like to thank our episode sponsor, Yiddy Meisner of Evergreen Insurance. Yiddy Meisner is not just an insurance provider, a property insurance provider. He's somebody who has, for many of my clients, come in and really wowed them with what he was able to get done. Cases that seemingly were impossible to get past, he figured out a way. He figured out a way to make things happen. And I know one specific scenario, I referred him to a guy in Wisconsin, a big-time guy, and he was ultimately floored how Yiddy was able to navigate a fire and really work things out. So you have a property, you need coverage, you need a good plan. Yiddy Meisner of Evergreen Insurance is the guy to go to. Thank you so much to our corporate sponsor, Michael Stern of Line Star Tax and LST Consultants. What a guy. Aside from the fact that he's a tax genius, Line Star Tax and LST Consultants has rolled out collections teams and leasing teams. These guys can get your property leased up. These guys can go ahead and help you with collections. These are guys you definitely should talk to. Folks that I've sent their way are super duper happy with them. Guys, tune in. This is going to be an exciting debate, exciting views on the tax landscape of syndications and general investing. Let's go. Hey everyone, welcome back to another episode of Stage Debate with Cost Seg Isaac. Today we have 3 phenomenal guests. We have Chelsea O-Shields, Brandon Hall, and Nicole DeRosa. Thank you guys for coming on. Obviously, we just passed the 9:15 deadline. You guys worked probably pretty hard late into the night, endless sleepless nights. I think everybody appreciates you guys at this point. Thank you so much for coming on. Chelsea, we'll start with you. Everybody's going to introduce themselves, give us a bit of a background on your career, where you are right now. Fill us in.
Yep. So I have been a CPE here in Tennessee for about 10 years now. Started right out of college with the firm I'm at now and haven't left. Pretty loyal. I specialize in high net worth individuals. I'm pretty sure most of the people you talk to at this point do. But I go a step further and specialize in partnership basis adjustments. So I work on a lot of buy-sell transactions just to maximize gains, pushing ordinary gains to capital and maximizing tax savings on buy-sell transactions, and ideally pushing that gain down the road as much as possible while still getting the cash. So do a lot on buy-sells, do a lot on partnership basis adjustments, and really just help in any way I can with my high net worth clients.
Very cool. Brandon, thank you so much for coming on. I love what you're doing. Fill us in. Tell us more for the folks that don't know you yet.
My name is Brandon Hall. I'm a CPA. I launched my firm back in 2016. My firm is Hall CPA. We work solely with real estate investors, ranging in size and wealth. So we work with, high net income investors that are buying their first set of rentals. We work with high net worth investors that already have a pretty substantial portfolio. And then we work with the sponsors of syndicates and funds that are raising a few $1 million to go buy apartment buildings, commercial property, et cetera. Our firm's 100% remote. I've got a team of 50 in the United States now, another 35 or so offshore, and we just made the IPA top 500 firms. So very excited for our growth. It's been a heck of a ride, but a lot of fun serving landlords and investing myself. So
very, very cool. And yes, we've crossed over with many mutual clients, and it's always nice to see your informative post on LinkedIn. It's an honor to call you a friend. Nicole, thank you so much for coming on. Fellow New Jersey-in, if that's a word. I really appreciate you coming on. Fill us in. Give us a background.
Thank you for having me. So my name is Nicole DeRosa. I am a New Jersey-based CPA. I've been in practice for over 15 years now. Pretty much, I like to refer myself as a one-trick pony. I've been in tax my entire career. Basically, started as an intern in tax, and I never wanted to leave. I'm probably one of those weirdos that gets excited over tax. I do a lot of tax education. I speak for Surgent CPA or Surgent CPE. I'm a brand ambassador for UWorld CPA Exam Review. I do a lot of national speaking on all things tax topics. And then I also speak a lot about personal branding as well. The clients I serve are pretty much from your, mom and pop shops to huge rental real estate properties, manufacturers, high net worth individuals, and everything in between. And I absolutely love it.
Super, super cool. And did you grow up in New Jersey?
I am born and raised, yes.
Oh, wow. Very cool.
Through and through.
Very cool. It's funny. I grew up in Michigan, and my wife is from Passaic, New Jersey.
Okay.
And before I ventured out into the real estate world, my whole world was either Michigan or New Jersey. And then obviously Cost Seg is a national item. And I got to know so many folks from so many different places. Chattanooga, right? North Carolina, many guys from different parts of California. And it's just so cool. And I go to a lot of these places, God willing, going to Houston next week for a show. And it's just, everybody has their niche, their way of doing things, different cultures, and I love it. Super cool. But New Jersey's the best. So Brandon and Chelsea, I'm sorry about that. Okay, Nicole, we're gonna start with you.
All right.
So obviously we're in the real estate world. We're pretty well versed with many nuances and details and different ways people run their shops. Everybody runs it differently. Some more on a corporate level, some more on a mom and pop level. I've seen personally so many big folks, and this is nothing specifically to do with Cost Seg, just in general from talking to them. So many folks, when it comes to the tax side of things, completely just confused, totally not having their ducks in a row. And these are people, some of them are folks that have thousands of units and everything is just a mess. Do you bump into these types of folks? What's your model? What's just your first step in just trying to structure something like this? And have you seen such a thing? Have you seen this often?
Yeah, I mean, unfortunately, I think we've all probably seen it more often than we would like to admit, which is kind of crazy because, people are making all this money and yet their books are in shambles. They don't know what's necessarily going on. They know what's going on at a top level approach, but when you get down to the numbers, it's sometimes a little crazy. It's like, how have you been operating for so long? But I mean, first thing is first with, getting an accountant that's competent and knows which side is up. They are up to date with the tax regs. They know what's potentially on the chopping block in the near future. I mean, obviously, we're in an election year right now, so a lot of things could potentially change. Bonus depreciation is phasing down. We all know that too. So I would say finding a competent CPA is top priority for somebody in this position. If you have a good accountant and a good attorney, you're pretty much setting yourself up for success. So that to me is step one, is making sure that you find yourself a competent CPA and also a good attorney as well. And, getting your books in a row, having, a bookkeeper, whether it's in-house or outsourced, very, very important as well. And I would just say understanding the business, having a meeting with your CPA, making sure that they're on board and they understand what's going on, what you're trying to accomplish, and essentially how they can add value to you, not just necessarily you, but maybe your family as well and future generations, because you want to make sure that you're setting yourself up for success for the future as well.
100%. And I've seen so many guys, they focus so much on, let's say, syndicators, capital raising, and they put a tremendous stress on management and even making sure that their property is producing properly. But then when it comes to the tax side of things, like you mentioned, there's just so much confusion. And I actually had a client of mine from Florida, and he purchases a lot of properties, nothing crazy big, $3 to $5 million properties, but we're talking about once a month. And he said to me, "Hey, Isaac, everything is just completely messed up over here. And so many things are falling through the cracks." I set him up with the CPA, and he's like, "Hey, Isaac, I'm not signing this engagement." He wants $150,000 for the year. And I said to him, I said, "Hey, you might be paying another 50, 60, 70 grand than you would have been paying with a smaller shop or less experienced guy, but you're really going to see the benefits here." And he called me up recently and he's like, "Hey, Isaac, this is eye-opening. Just everything being organized, there's a calculation to everything. It's not just 30 different LLCs and 30 different names and just all over the place." And I think people have to really realize more and more that, again, aside from the cost side of things, just regular tax-related issues that you have, just having that in order not only is important, but that could be the game changer between having a profitable business or not. So it's really not just an added, oh, let me get a good CPA. And you shared about that idea of educating people. And I think that's so, so important. It's not just doing the work, educating folks on what they're missing out on how they could be more, how they could set their systems up the right way. That's super, super important. Thank you. Brandon, so we just talked about this idea of folks not having their ducks in a row. Obviously, you probably come across your fair share. Are there ever situations where you're just like, hey, this is just not going to work? I can't deal with these types of guys. They're just too over the hill, too all over the place. Where's your like cutoff line? Or you like getting down and dirty and like, hey, I'm going to go into this mess right now and fix it up. And obviously the feeling of that afterwards is probably pretty crazy.
Yeah, we typically don't like go into the multi-year messes. That's just typically somebody that does not have their life in order and will not get their life in order by working with you. So you can organize as much as you can for the client. We've done this before where you catch them all up, you get them all organized, and they just continuously let it go. So it just doesn't actually help them in the end. We like to work with clients that take it seriously, that are organized and will treat your advice like they're paying you all this money for. They'll treat it very seriously. The funniest thing for me is always when people come to us and they're very unorganized. They haven't done their bookkeeping in 2 years. They haven't filed their prior year taxes yet, and they're just a mess. And they go, "Well, I want tax savings." And it's like, well, you gotta start by just crossing your T's and dotting your I's. Like, we can't help you get tax savings unless you do have good accounting practices and you do have good documentation practices. Those are the people that benefit from the tax savings. So those are always the interesting folks for me too. And in recently, we have, and by recently I mean since January of this year, we have seen a sharp uptick in audits related to Section 469, which is the passive activity loss rules, real estate professional status, the short-term rental loophole, all that stuff. The clients that are, and these are like people coming inbound. We've had a couple of our clients audited too, but the clients that we take on that win these audits are people that are organized. They have time logs filled out. They have documentation for everything. The people that lose are the ones that are trying to retroactively create time logs only once they've been audited. And at least they can come to us and we can say, you need to have this time log before that first meeting with the auditor so that it at least doesn't look like they retroactively created it. But those are the people that are going to lose every single time. So being organized is part of saving money on taxes. It's part of tax optimization. And if you can't get organized, you're really just not ready for those sort of like, what I think we would call advanced planning strategies.
You brought something up, Brandon, and Isaac, you touched upon it before about fees. So I don't know about you, Chelsea, but I mean, clients are, I would say, becoming more and more fee sensitive every year. Now, obviously, we increase fees. There's an inflationary adjustment every year with fees, and there's also a value to our fees. And I'm curious if you've had more conversations over the last couple of years with your clients, to kind of rationalize your fees and the value that you're providing and what you've seen. I know I personally, had these conversations. Unfortunately, they always come up. And, if a client values your services, they will pay the fee. And if they feel like they are getting a benefit. And oftentimes I'm finding that it's the clients that don't necessarily have their ducks in a row that are unwilling to pay the fees, but still want you to go the extra mile.
Oh, yeah. Yeah, so it's funny too, not to harp on any of my clients, but I guess I kind of am. I have a client that probably pays us $500,000 to $750,000 a year. I do a lot of work for them, multiple dealerships across the Southeast. I pretty much work on his stuff as a side full-time job. He's never once asked about the bill. I could bill it 100%. I keep it fair. I do bill what I think is within the realm of the value I've added, but never once get asked, never once has come back and said, hey, I don't know if that's fair or not. I don't even know if he looks at the invoice. It's immediately paid within a day of sending, 0 complaints. And then I have a client local, just a local coffee shop. I do it as a favor. It is so far, I don't know if the firm would accept them as a client on a normal day. That they can't really pay that much, but they're local, they're good people, and so we do their work. I charge them probably half of our minimum of what we would do, and they still complain. I And I just want to say, like, you guys are so far out of the realm of reality and how these things work. Not only that, since I do mostly partnership reporting requirements have gone up extensively. To file a partnership return now, just the compliance work on it, compliance alone, no value add, is so much reporting to get it right. And speaking to what Brandon mentioned, an IRS audit, if they can't get you for one thing, they're going to find a way to get you on something else. And if it's something as stupid as you didn't check a box, they will do it. So as stupid as that sounds, as hard as it is for me to say, hey, I'm charging you of that bill, $700 is for me filling out a K2 or something. It doesn't matter now, but it will matter in the future. And when it does matter, you're going to be really thankful you paid $700 for that. So, but you can't explain that. So they are definitely more cost sensitive. And we've had this discussion in our firm. A lot of the partners that I work for are older gentlemen who shook hands on a golf course, and that's how they got the client. And it was all handshake deals back then. And when I say back then, I'm talking like last 20, 30 years. But back in the good old days, it was all handshake agreements. You like the guy, you shake his hand, you'll never leave because you had a handshake agreement with that man and your word's your honor. That is not the reality of today's business owners. They want value add. They want you to prove what you're doing for them. And they are not necessarily going to stay with you through thick or thin. They are a lot less forgiving than the golf course guys. So I am constantly having those discussions. And I try to be proactive and say, hey, this is what I did for you this year. And I just wrote a LinkedIn post about this the other day. It's so hard not to sound gimmicky and say, hey, I took bonus depreciation on that. That's such a standard operating procedure. That's like a doctor saying, hey, I inserted your IV correctly. Like, no, duh, it's part of the job. But they truly don't know that you've done that for them. So I'm trying to be more proactive, but it's hard to not be gimmicky when you do it. It really is. But if you don't, you run the risk of them saying, hey, this other guy told me about bonus depreciation. Why didn't you tell me about it? Because it's not a thing you tell someone about. You just do it. So I don't know. Sorry to go on that rant, but Nicole, you're
I like that. It's so true. Wow. Once we have you on, Chelsea, I want to jump actually to a different part of the field right now for a second, because I want to make sure that we cover this topic. I'm curious what you guys have to say about this. So folks call me all the time about specially allocating depreciation. So an investor comes in on a deal and they're like, hey, we're going to get X amount of dollars back in depreciation. Let's say they're a real estate professional and they could actually benefit, or they have a lot of passive income and they're able to benefit. By the way, that's a huge problem in and of itself, as you guys are well aware. Syndicators will talk about bonus depreciation, and many times the investors can't even benefit from it. But assuming that they can benefit, and they want the syndicator tells them, hey, we could give you some of our depreciation. And I've seen it happen, and the attorneys and the CPAs will structure the OA in a way where they can do that. Have you guys ever dealt with any situation like this? What's your take on it? Is it possible? How hard is it to do? Is that something syndicators should go around talking to people about? Because think about it, if the syndicator himself is actually putting money into the deal and he's entitled to part of the depreciation even before the promote kicks in, he could go ahead and give it away to somebody to push him over the top. If that works, let it go. Let it be.
I'll say I just recently dealt with this. We were able to justify it by, I forget what code section is, the economic substance rule. If you're contributing money and playing the active manager part in the business, then losses should probably be allocated to you if your other investors have no capital, have never put money in. But when you're dealing with investors, multiple investors contributing, and you're only allocating that bonus depreciation because someone else can't take the losses, I don't know. I tend to rely pretty heavily on the operating agreement. If it says allocate losses to those with capital first, then I'll suggest a larger capital contribution, possibly take the losses, but you don't want to get in the way of people's money either. I probably haven't seen it as much as Brandon, so I'm interested to see what Brandon has to say.
Yeah, you can make special allocations of depreciation. The problem is when those special allocations cause negative capital accounts, because the first year you can absolutely make that allocation and everybody's happy. But the next year, what happens is if one person or one subset of investors has negative capital accounts and the others do not, then you have to allocate items of gross income. to the people with the negative capital account. So this year I might get the big loss, but next year I have to essentially pay it all back. So whenever we're talking about special allocations of depreciation, if it's going to make capital accounts go negative, it pretty much comes off the table in terms of a discussion. And to answer one of your questions, Isaac, should GPs be telling investors about this? No, they should not. Just don't be promising that you can specially allocate depreciation. If you can make it work, awesome. But we've just seen a lot of that recapture, that allocating items of gross income.
Let the deal talk for itself.
Income. What's that?
Let the deal talk for itself. Don't use that. I'm saying depreciation it's leverage. People, when you're investing 200 grand in a deal and you're going to get benefits, that there is a way to look at that. Hey, I'm not really all in for 200K. But if you start playing around too much with it, and Nicole, you don't agree with me.
No, I do. I just think we should take it one step further. Bonus depreciation, you accelerate year one. It's obviously a timing difference. And in a lot of states, depending on what state you're in, it might decouple from the Fed. So you might have a huge state add back. And
New York, for example.
New York, New Jersey.
New Jersey is a state add back as well? I thought it was New York and California.
We're capped, depending on, again, we decouple. But there's year one, great. It's not like you're almost over promising, under delivering, because if you look at it, couple years, right? Year one, amazing. Year two, you have a reversal. Year three, you still have a huge add back. It's not necessarily as wonderful as it originally seems just for year one. And also, special allocations, it's not like it's just done overnight. So your fees, your accounting fees, are going to probably be significantly increased as well for this work. And again, making sure that the states all flow properly is also very important too, because you have to specially allocate the state stuff, not just the Fed.
Yeah. Debt basis can help take those losses, but usually what you see is one investor. From my end, Brandon, again, you might see something different since you're knee deep in it. We usually have one investor that'll guarantee the debt, because they're the ones with the reputation with the banks that they're using. They take on the risk and they have all the basis to take those losses. So, and you're not putting real estate in an S Corp or a C Corp, so it's mostly all held in partnerships regardless. So you're really seeing a lot of this debt basis come into play too, and it gets kind of finicky there.
Yeah, the issue that we see with guaranteeing debt is that the guarantee is more like bad boy carve outs, and it's not actually a guarantee. And Chelsea, I don't know what states you guys work in, and so I'm not 100% familiar with Tennessee. Even if you guarantee debt as a member of an LLC, you might not actually be responsible for the debt. It does depend on state law.
It does.
So you could
and the
guarantee
IRS will come after that too.
Yeah. Yep. Exactly. So you could guarantee debt, but still not actually get any benefits of guaranteeing it.
Yeah.
Tax
you
benefits
do
of guarantee.
Get qualified non-recourse debt, which is heavy in the real estate world, obviously, because the mortgage component, that can help a little, but no, I completely agree. That recourse debt, it has to be at the end owner level. If this thing goes under, do they have to pull out of pocket? And a lot of times with state law protections, that answer is no. So it is definitely something to consider. And then one thing I wanted to add, Tennessee just followed federal on the bonus depreciation deduction. So we might have you guys beat on that one.
Yeah, you definitely do.
So, I just wanted to throw that out there.
Very cool. So, Nicole, tell us, what is the biggest mistake you see real estate investors making?
Oh,
that's a tough one.
I would say the biggest one that I see is they just wait too long sometimes to do things. Obviously, year-end tax planning, we like to accelerate your expenses, defer income, push it off. But, people are a little bit adverse because of the bonus phasing out, because they're like, oh, well, let's wait and see. But now it's like, no, it's still phasing down. So take advantage of what we know to be true rather than the what if factor. So I would say accelerating expenses, sometimes they just wait till last minute and they don't necessarily place them in service. Cost segs, people wait to the last minute to do those too. And then it's like we're holding the tax return, it's been extended and we're waiting to file for, 9/15, 9/16. And it's like we're still waiting on the final numbers because they waited to get the cost segs done.
You can't send out the K1s. There's just so many.
Horrible. It's
horrible.
it's horrible. And I would even say the 179D studies too, that's become, I would say, more popular over the last couple of years. Similar, they wait to get those done. These studies don't just, happen overnight. They take time if they're done the right way. So we want to make sure that everything is documented, because these are big numbers for tax credits that we're taking. And also, you don't want to double dip, because that's a big no-no too. But just waiting till the last minute to do things is, I would say, not necessarily my biggest pet peeve, but the biggest no-no that investors seem to do.
It's funny because CPAs and investors, if you think about it, are two different types of personalities. CPAs are generally the people that actually sat through school, got good grades on their tests, and the real estate investors are usually the folks that are all over the place. So it makes sense. You need the CPAs. We need you guys to knock sense into everybody. Hey, this is only going to work if you do X, Y, and Z.
We can try all we want to be proactive with our clients, but at the end of the day, they're the ones that have to make those decisions. And it's like when you're stuck between a rock and a hard place and the deadline's not moving, it's like every time.
Nicole and Brandon, how many failed 1031 exchanges have you seen from just poor planning?
Luckily, only a handful, but I know Brandon's probably seen a lot more.
And those are the rules are there. They're set out. They're the exact days. They give you the exact days. And the clients that fail it still shocks me.
You know how many times we have a 1031 division. Do you know how many times they get calls from folks and they're like, hey, do you guys have any leeway with the 45 days, with the 180 days? I'm like, no, that's not us.
They don't do it into a qualified intermediary. It's like, what are you doing? You just blew,
or they'll come to me after the sale and they'll say, hey, I'm sitting on all this cash. I'm not going to use it, but can I roll it into something else and do a 1031 exchange? I'm like, you didn't even tell me you were selling a property. That would have been where we started. Right there is when we would have started.
We all probably have had that happen, where our clients tell us what they did after the fact, and then they ask us what they could do differently or what can be done now. And then they get mad at us because we just tell them the regs and the rules.
Brandon, what's the biggest mistake real estate investors make? And the second part of the question, and I want everybody to chime in over here, is about bonus depreciation coming back. Obviously, Nicole mentioned it. I have so many guys who are like, hey, we want to wait. We're not sure if bonus is coming back. Let's wait till after the election. Give us your take on real estate investor mistakes and bonus depreciation coming back.
I would say the biggest mistake, and this is going to sound self-serving, is just not working with a professional who is going to be proactive and have some level of consulting throughout the year. I mean, if you're working with a professional that is just doing the compliance, that is a step up from DIYing it. To Chelsea's point, people will say, aren't you just filling in boxes? And the answer is primarily yes, but it's the right type of boxes. And, an example of that is we've got a couple IRS audits where the taxpayers did not make a grouping election for their rentals. And if you don't make a grouping election, you have to materially participate in each rental separately in order to make the rental activity non-passive and then use the tax losses. And to make a grouping election, primarily just checking a box, literally knowing what box to tick in the software. It's not a lift. It's not crazy. We effectively do it by default for all of our clients. But it is absolutely something that IRS will say, gotcha, too bad, so sad. You didn't make the election, you lose. Because you can show that you materially participated in the entire group, but not each rental separately. So therefore, you can't use the losses. So, using a professional just for compliance is a step up than just DIYing it. But taking it a step further and really getting that proactive planning goes a long way. Like Nicole was talking about, just letting us know 2 months after the fact that you had all of these changes is not good, right? You want to be checking in at least, I would say, quarterly for most land. Not if you have one property or two properties, you're not really making any changes, growing your portfolio. But most of our clients are actively trying to build their portfolios, and we want them to be checking in with us pretty consistently. And we have a CRM to ensure that we check in with them pretty consistently throughout the year. So if you do that, you'll mitigate a lot of those mistakes, and you'll get that kind of forward look. I would say that's probably the biggest mistake, is just not knowing how to use a tax professional proactively is probably the biggest mistake in summary. In terms of bonus depreciation, we actually think that we think that the legislation will pop back up regardless of who wins the presidency. It is pretty bipartisan, and bonus depreciation is also a very pro-growth tax change. Nicole was mentioning it before. It's a timing difference. which is about as pro-growth as you could possibly be from the federal government perspective. And what I mean is, you can stimulate a lot of investment today, but the government over the span of 10 or 20 years doesn't actually lose on the GDP, right? So they actually they will take in the same amount of money just over a longer period of time, and GDP increases at the same rate because there is that recapture, that depreciation recapture that you would eventually have to face. So I think that we will see some permanency to bonus depreciation come out this November, December, January, whenever it gets back on the docket. I don't know if it'll be 100%. I don't know if it'll be 50%, but I would expect it to be on the docket for discussion.
Absolutely. And something I tell all my guys all the time, and they all ask me, and just in simpler terms to them, I just say, hey, the more money that's in your pocket, the more investment properties you're going to buy. And the government, and especially the smart guys, they realize that. So they incentivize you by giving you more money up front, and that gives you the opportunity to buy more properties. And banks are rolling, and everything is just the machine is being oiled. The economy just runs better. It's my take, and obviously, whether we like Trump or not, he's a smart guy, and he's the one who officially, I guess, brought in bonus depreciation in 2017, and he was a real estate guy, and he realized that. Hey, this is how we're gonna oil the machine the right way.
Yeah,
Nicole and Chelsea, fill us in. What's your takes?
I was going to say, I agree with Brandon. I do think that it should stay. We've been saying bonus is phasing out for probably easily over a decade now. And for the first time, it finally did just start to phase out. My concern is the timing of when it's decided. Is it going to remain at 80? Is it going to go back up to 100? Is it going to phase down to 60? Because, I hate retroactive changes. I hate having to extend returns and wait and see, just because obviously that creates a huge bottleneck and it's just not efficient for anybody. So if and when hopefully it gets back on the docket, I hope that something is settled before year end. Realistically, I don't see that happening just because of the fact that it is an election year. And, our extender packages haven't really been as year end ish as they have in the past. So I think that we are probably going to be looking at something that happens after year end retroactive back, unfortunately.
Yeah, the 2017, that retroactive application of bonus depreciation was an absolute nightmare, but we survived it, and we'll survive another one. And, it's with the political landscape, the shifting changes every 4 to 8 years are dramatic compared to what I think the people we used to work for experienced. Anytime one of them is like, oh, the job's not that hard, I'm like, our job is entirely different than what you did when you were my age. So I'm a huge fan of bonus depreciation, though, in general. I want it to stay. It makes my job really easy. I work with a lot of dealership clients who are working on expanding. Dealerships, kind of similar to the CPA world, you either grow or die. So a lot of them are in extensive growth mode right now. And that's the easiest win for us. They're buying $15 million facilities. We can get them to take, half of that as a deduction in year one. It's an easy win. And that's another thing. People with a lot of money have a vested interest in keeping bonus depreciation around. People with a lot of money have a vested interest in keeping the QBI deduction around. So I don't imagine that one's going anywhere either, if I had to guess. The more tax savings it creates, the more likely it is to stay around. So I'm feeling pretty good about bonus depreciation not going anywhere. To Nicole's point, I don't know if that's going to go back to the 50% that it used to be forever ago, or if it's going to linger closer to 100. I would love if it stayed at 100, because that makes those timing differences for federal and book a lot easier. And I would love if every state got with the program and allowed it too, but we'll see.
Why are the states against it? What obviously brings in less money for them? Understood. But
it's a timing difference. So you sell the property, they have huge add backs, and the taxpayers can afford it. They don't have to set up installment agreements because they sold the property, they took the cash, now they get to pay for it. It makes the most sense. You're kicking the can down the road, but it's almost a guarantee that you get your money in for taxes, because clients have a huge influx of cash from the sale of these properties when they recapture it. It's a no-brainer. It really is. And if they're working with a good CPA, they've already planned for it. So it's not like they're avoiding the taxes. They're just, to Brandon's point, it's encouraging growth. More people are likely to participate in it. And then when those properties sell, which they will, as business booms, there's an influx of cash, and then all that cash goes to taxes. Not all of it, obviously, that's our jobs, but a good chunk of that cash goes to taxes. So I am a huge fan of bonus depreciation and what it does for local communities. And I think states should start to realize that. And a lot of states, they allow Section 179 and not bonus. I think it's just because they don't understand the impact. But hopefully now that it's been around for forever, they might finally get it.
Got it. And Brandon, I see your emails all the time, and you talk about the short-term rental loophole, and folks call me. Obviously, it's always more exciting to do $20 million strip center than $400,000 Airbnb, but I'll take it. I would say 20% of my business are these types of properties. Folks make a lot of mistakes, and we talk a lot about real estate professional status, but it's a hot topic that the IRS, I think, is getting a little fed up about. I think a lot of people are just checking that box. If they have aggressive CPAs, they don't really care, take any chances. Okay, make your wife into a real estate professional. You did 600 hours. It's close enough. You didn't document it. Where's your red line? Where's your red line of hey, you're just not going to qualify? How do you, figure it out? And obviously, you try to make the client into a real estate professional to help him, but sometimes you just can't.
Yeah, I mean, we're pretty hardcore about it. We won't take the position, real estate professional status or material participation in short-term rentals. We won't take that position on tax returns unless you furnish us a time log that we then sift through and agree with. So, we'll call out like it took you 10 hours to do your bookkeeping every single month on one rental. No, it did not. It took you 8 hours to set up your VRBO listing. No, it didn't. Right. So we push back on our clients. We say, look, like we're happy to take this position. A lot of your tax strategy depends on this position, but we're not going to take the position if you're setting yourself up for failure. I used to be like this, and now I hire the people that are like this, but I used to just read tax court cases for fun, right? I mean, and a lot of them read like narratives, to be honest with you. It's actually like very interesting to read through this stuff. But I hire guys and women that just crank through these tax court cases like it's candy. And so that allows you to build up a big knowledge base of what works and what doesn't work. And, we're just not going to take positions that we know are not going to work. So, people that come to us with heavy investor level hours that are not involved in the day-to-day operations, we're not taking the position for you. If you are, going to some, I'm not going to name them, but cruise, 3-day educational real estate cruise. Sorry, none of that time counts for real estate professionals. I don't care what CPA tells you that, right? Like, it's just not going to count. So the education, the research time, the investor level time, traveling 3 hours to my rentals, none of that stuff counts. So when we see that type of stuff, we say we help coach on it. We help them get squared away. And typically the end result is I need to be more involved in my rental operations. And over the past few years, we've had pushback, right? We get a lot of pushback because they'll go, well, this other CPA that all my friends are using is going to allow them to do it. And we'll go to that CPA. Sure enough, guess who we're helping now with audits? That CPA's clients, right? So it's like you can certainly have a CPA just check the box. Somebody will do that for you if you pay them enough money. But it can put a target on your back. And something that I try to explain to people is, hey, if I took every physician that came to me and said, well, I want to qualify as a real estate pro, and I'm only going to work with you if you let me, and I said, sure, whatever, the audit risk is so low, and the IRS pulls one of my physician clients and goes, oh, wow, like Brandon really gave terrible advice here. And then they go pull 3 more of my physician clients. They go, wow, there's a pattern of Brandon providing terrible advice to physicians. Let's go pull all of his clients for an audit. That stuff happens. And I think that people just never really appreciated that, and probably still don't. But I think it's coming, man. We're feeling it. We're seeing a lot more of these audits come through the front door. And I don't know. It's just it's an area of the code that we just say, look, you want to play games, you want to play stupid games, you're going to win stupid prizes. So just be careful.
Professionally, our due diligence is to make sure that we're asking the right questions and that we are only doing what we are comfortable with, in the sense of making sure, obviously, if it looks like a duck, it acts like a duck, it is a duck. I feel like there's a lot of people who maybe unknowingly do things that are not great. But with that also being said, people are going to get what they pay for. I also think that, it's a pretty, I'm not going to say a bright line test. There is a lot of gray, and I say, play in the gray. That's fine. But you know pretty easily if somebody is a real estate professional or not. It's not, somebody has one rental property and they come along saying, oh, I'm a real estate professional. It's like, no, you're not. You're working full time here. You have one rental there. Like, you're just trying to get your mortgage paid by your tenants. Like, you're not a real estate professional. So, if somebody has 20 different properties and that's what they're doing day in and day out, it's pretty obvious. So, I mean, the real estate professional election, I feel like oftentimes you know pretty quickly if it's legitimate or not.
Yeah, that one property thing, we see so many. So a lot of my clients that have dabbled in real estate, they get their money elsewhere, and then the real estate is just such a small piece of it. And I'm sure until they grow that real estate and develop it into something else, that's a pretty common case. If they have one short-term rental, I just immediately am like, there's no way. There's no way. And if you're actively operating this other business, there's absolutely no way. And a lot of them, and Brandon, it may have been your post. There was one story I read recently. The guy did have a high-paying W-2 job, but he still qualified as a real estate professional because that high-paying W-2 job was, he could put in 8 hours a week and it worked. So he had the time to spend.
Yeah.
Brandon, now that I think about it,
Miller versus Commissioner. Yeah.
Yeah. And this was your post. And the grouping election is what got him. But so you cannot know that unless you know your client. And again, the compliance only CPAs aren't knowing their client. They don't have time. They're churning out tax returns. They're just there to file. So, which goes back to the biggest mistake you can make is not having a partner CPA. You can have a CPA, but there's a difference between a CPA and a partner CPA that knows everything about you and your business, knows your goals, because a no-brainer tax strategy may still not make sense for someone with a 5-year goal of X. So those single short-term rentals that they think they're a real estate professional on get me every single time. It's such an easy loss because when they come to you, they already know that's what I'm going to do. I'm a short-term rental professional, and you have to shoot them down.
No, but 1 second. Short-term rental, there is a loophole that, tell me, Brandon, you post about this all the time. You don't have to be a real estate professional for short-term rental if you're managing it, I think, 500 hours or something, right?
Right.
Yeah, I actually wanted to circle back to the Miller versus Commissioner thing because, Chelsea, you said he qualified as a real estate pro, but then he didn't make the grouping election. So it's just like one of those funny things where he actually did pretty good on the strategy piece, but he didn't have the compliance locked down. He didn't check the box. Like that's the funniest thing about this stuff. Like you can do all this work and then just not check the freaking box, right? Yeah. So because he didn't check the box, the IRS or the tax court was like, yeah, you're a real estate pro, but you didn't say that you didn't group your rentals. Yeah. So you have to materially participate in all your rentals separately, and you didn't do that, so you lose. Exactly. And it's just bizarre. But yeah, to Isaac's point, so there's a regulation that defines what rental activities are not. And if you rent your property for an average period of customer use of 7 days or less, then you do not have a rental activity under Section 469. And Section 469 says there's 2 types of passive activities, one of which is all rental activities, unless you qualify as a real estate pro. So if you don't have a rental activity, then under that piece of it, you don't have to worry about qualifying as a real estate pro. But you do have to materially participate. So you do have to meet one of those 7 tests. Our clients are typically going to hit 500 hours, substantially all, or 100 hours and more than anyone else. But everybody that does the 100 hours more than anyone else, again, it's like crossing your T's and dotting your I's. What do they all do? It's like, well, it's at a distance. Like I'm self-managing. Okay, that's fine. We could probably make that work. But they all fail to track the time that everyone else spends managing their rentals. And there's a court case in 2020, Lucero versus Commissioner, and he had a bunch of problems with this time log anyway. So the tax court was like, well, we don't trust you. But they opined. They said, okay, even if we did accept your time log, you still didn't show us how much time everyone else spent on your rental. So you still lose. And so that's the other thing. It's just like, it's knowing all these little nuances to really shore up your position. And these are all gotchas. They're all gotchas if you get audited, right? It's all kind of set up so that the auditor can be like, well, you didn't do this piece, so too bad, so sad. And if you want to challenge me on it, I'm going to say you lose. If you want to challenge me on it, you can go to appeals, then you can go to tax court, and that's going to cost $10,000. And how many people really want to throw money at that, right? So it's just it can go downhill fast if you don't check all the little boxes, cross all your little T's, dot all your little I's. Yeah.
Low hanging fruit, and they know it.
Yeah.
They know it.
Yeah.
I mean, they go straight to it to look for it.
I mean, I think within the next I'd say 1 to 3 years, I think we're kind of there. I think audits are going to substantially increase next year and for the next several years. Because I feel like, knock on wood, they've been pretty lax the last couple of years. COVID kind of slowed everything down. But I think we're coming out of that, and I think audits are going to pick up again, unfortunately.
Yeah. They've been beaten down heavy on conservation easements. We had some clients invest in those, which are, risky in and of themselves. But I feel like they've focused all their energy there, and now that those are running up, they're going to hit something else hard. And
basis. I think basis is a ticking time bomb between, partnership capital reporting and, the S corps. It's a matter of time before that bomb explodes.
And you can already tell they're looking at it by the new S corp reporting and partnership.
7203. That was literally them saying, "Hey guys, we're coming at this.
Yeah, we're looking at it a little closer." Yeah.
Once they go through the truckloads of God only knows what's in there, I definitely think that's on the.
And that's I don't know how to tell clients. It is far more important to have a CPA that can sleep at night, comfortable with their decisions, than to have one that's just going to get you the biggest deduction immediately. It is terrifying to risk your CPA doing something. And some clients get pushy. Some clients are very, very aggressive with what they want, and some CPAs give in. And I'm sure they're losing sleep at night over what they've done. The ERC credits were a big one. Our firm took a very hard stance on that, and there's other CPA firms that are paying for that now. And I would feel 10 times more comfortable if the CPA told me, "Hey, we're not doing that. You can push it all you want, but we're not going to do it." I would immediately have trust in them, because I know the deductions they do get me are going to be good, or I know the basis that they do put on my K1 is going to be correct, and that means a lot more to me. But some clients see it as a waiting game. There's a risk that you get audited, and if I don't, it was worth the risk. You should never make a decision based on the risk of getting audited. You shouldn't, but some clients do that.
I know guys that play the game, and I say to them, "I'm gonna you sleep at night." They're like, "Hey, I'll pay the penalties. I'll pay this as long as I don't go to prison. I'll pay all the money. I'll take the chances right now." Yeah, definitely not me. Okay, guys, last question of the show, and this is something that I'm excited about. This question. So, like I said earlier in the show, CPAs by definition, in my mind, it could be I'm wrong, are more like attorneys. You guys got hundreds on all your tests in high school and college, and people like me are the ones that fooled around a little bit, but we're sales guys. You guys obviously have to do the back office work and know your stuff, and obviously you guys all know your beans. But you guys have to be salespeople as well, because you want to pick up clients, right? You want to pick up clients. So how do you integrate that in terms of marketing yourself? If it's not, even if it is your specific personality, I'm assuming that there's many, many CPAs out there that it's not their personality to just be this extrovert and start posting on LinkedIn and being that salesy type of person. You guys are already past that stage. You guys have a clientele. How'd you get there?
It all stems from confidence, and I think confidence comes from being well versed on what you know. And the better you are at understanding tax code, or the more experience you get with helping clients and being confident in your decision, that comes with it, having the ability to speak to people and tell them what you can do. But that aside, I would go to conferences. So I used to work in the automotive space a lot, and I would just go to conferences and shake hands with dealers. And a lot of my personal brand in the CPA world came from that. Just literal face-to-face interaction. Now, dealers are a little bit different. They want face-to-face. They want the handshake, and they want to see you. But a lot don't necessarily. I also like working with vendors. So, Isaac, you would be a vendor client for one of mine. If I have a client that I recommend a Cost Seg to, I connect them with you, vice versa. I do that with attorneys too. They become referral sources. They become good friends. We work together on the same projects. And then I know there comes this point where whoever you refer your client to, they can make you look really good or really bad. So it's no longer just helping friends. It's very much like my reputation depends on you coming through for this client. When I learned that lesson, it paid dividends in terms of personal brand. Surrounding myself with a network of people with the same standard and compliance requirements as me, but also on the same level of, hey, we can get creative when needed.
Very cool. Nicole, did you find it easy just branding yourself? You aren't Mrs. Introvert. You definitely are outgoing, but at the same time, again, it's a question for CPAs in general, because I know many CPAs who are just to themselves. Now you got to get your branding out. People have to find out. And obviously there's referrals and you do good work, you post smart stuff, but what's your take on that?
So one of the things that I always like to say is get comfortable with the uncomfortable. Put yourself in positions that you're not necessarily coasting through, because that's when you do your most growth, in my opinion. I was deathly afraid of public speaking for the longest time. And I was an adjunct professor for 4 years because I was like, let me put myself in a position that I'm not comfortable in. It's students that don't know anything. So if I mess up, they're not going to know. But it got me comfortable with being uncomfortable. And then after that, I started teaching, and now I speak at national conferences in front of hundreds of people. It literally, you take these steps, little steps that over time get you comfortable, and, differentiating yourself, kind of setting yourself apart, figuring out what kind of, makes you unique and your authentic self. For me, I always say, follow your passions and make sure to live your passion and integrate that into your profession. And if there's a will, there's oftentimes a way. So, for me, it's teaching Zumba, which people don't equate Zumba and accounting or Zumba and CPA, because we are stereotypical hermits who just kind of sit in a dark room all day and don't socialize with the world. But I mean, showing that there's more to the profession, more to being a CPA, I think can really set yourself apart. And then people naturally kind of just come. You surround yourself with like-minded people, and, word of mouth. You might not think it's clicking along the way until it eventually something comes down the pipeline. And then they just keep coming down the pipeline if you're lucky enough. And you have to keep working at it too. It doesn't just, you don't just put in the work and you're done. It's constant work if you want to be good at what you're doing.
100%. I love it. Brandon.
Yeah. Nicole and Chelsea nailed it. I'll just add that branding, marketing, sales, it's a learned skill. So nobody starts off just being amazing at it. Like if you really peel back the layers and explore their history, they all started from scratch, figured it out along the way. But the logical piece to this argument, in case you really need this logical push, is you can always build amazing organizations around people that can bring in business. And you compare that to people that are really highly technical skilled. You need those people too, but if they can't bring in business, there is no business. So bringing in business in terms of leverage is one of the highest leverage skills that you can build as an accountant. And I would say the second highest would be being able to lead a fulfillment team better than anybody else can. But I just think about I think about skills and time in the form of a leverage pyramid. And on top of that leverage pyramid is bringing in business and doing it in a scalable manner. Because if you can bring in $2, $3, $4, $5 million of business a year, what firm is going to turn you away? Right? You will always have opportunities to work, to make money, to add value if you can bring in business to such a degree as that. So I would just encourage you to get out there and build the skill set. It takes years to build. It's not overnight. Don't expect it to be. To Nicole's point, I used to be terrified to public speak and get on podcasts. And now I'll literally just walk on stage, and 2 minutes before I walk on stage, I'll text my EA and be like, hey, what's the topic for this, by the way? And she's like, dude, you stress me out, man. I'm like,
I want to get on your level, Brandon. Jeez.
Yeah, well, you do it so many times, you just have it memorized, right? So that you can get to that point. It takes time, but you can absolutely get to that point. And it's just repetition. It's just like any skill. You just get the reps in, and you'll build the skill.
All right, cool. What's the goal? The goal is eventually to build up Hall CPA to hundreds of employees.
Yeah, I don't know, man. It changes every once in a while. First, it was 100 million, but I think I can go a lot further than that. And the question is just going to be, how long do I want to go?
You retire, you move to New Jersey. We'll show you the nice places.
We'll take you to the shore, because it's the shore, it's not the beach.
Brandon,
Yeah.
we don't have pets, so.
What's that? What's that?
So we don't
Nicole,
have
what's the goal? What's the end game? Are you a partner in your firm?
So I'm no longer with my firm. I'm actually
Oh, wow.
doing something a little non-traditional. I'm kind of splitting my full-time into 2 semi-part-times. So at the end of the day, my goal is to just be happy and to find that balance, because I feel like oftentimes we struggle to find that work and that life balance, and it all kind of melds into one. So my goal is to further the pipeline or further the profession and kind of enhance the pipeline. It's like a little passion project of mine, while also continuing, constantly learning and doing the whole compliance thing as well. So it's kind of like, for me, it's like the best of both worlds, if you will. And like I said, it's a little bit non-traditional. So stay tuned, because there is some big news coming as to where I'm
Wow.
landing.
That's pretty
exciting.
cool.
Yeah.
That's
So
exciting.
to be happy. That's it. Plain and simple.
Exactly. No, I love that. People run their whole lives and they become workaholics and they can't even enjoy anything. So no, that's cool. And Chelsea, I think we talked about this, some big goals coming up at HHM, right?
Yep. Yeah, absolutely.
You can see yourself there for the next 30 years.
I can. I joke. I drink the Kool-Aid. We have several people that leave and then we'll come back. There was one guy who left to go to 3 different clients and is now back with us. So I kind of take their actions as testimony that I should just stay put. But I've gotten job offers from clients. I probably get 1 a year. And I think we talked about that, Isaac. I love doing this. I will make partner. Partner is not the goal. It's going to be a byproduct of just my passion for the industry and to learn. One thing you'll hear a lot of accountants say is it depends. That's our favorite word. And it's just because there's always some underlying factor that could change everything. And I love finding that and knowing it and just being the person in the room that finds the missing puzzle piece. So I guess the goal would be just to grow my reputation in my community, more specifically in my community and in what I do. So buy, sell transactions. I'd love to eventually, probably in the next 20, 30 years, be the go-to person for gain calculations and gain deferrals on those. That everything else would be a byproduct.
Love it. Super cool. Chelsea, Nicole, Brandon, thank you guys so much for coming on.
Hey everyone, thank you so much for tuning in to the Stage Debate podcast. This was a fun one. Appreciate you guys tuning in. Definitely connect with me on LinkedIn, get a hold of me. Let's talk podcast, let's talk Cost Seg. Subscribe and get notified for all future episodes. Thank you and have a great day.